Hey, what's going on, everybody? This is Scott Zarrett with CPA Academy. Glad to be here with you, and hopefully you're glad to be here with us too. This should be a two-way street. So let's confirm that you are here, ready to go, and excited to learn some more information. We are going to wait for your comments to come in before proceeding. So ball's in your court. All right, good. There we go. Thanks. All good. Thank you, Carolyn. And lots of others that are checking in with us as well. So we appreciate your participation in this course. I think you've made an excellent decision. This is a class that's been a staple on our platform now for quite some time, and we've had the benefit of reading lots of audience evals and getting lots of really, really positive feedback. So this is a good one, and we just want to make sure that everyone knows exactly what to expect over the course of the next hour, so that everyone can get credit and make sure that your questions are answered. So that's our goal. Hopefully you're on the same page with us there. And on that note, how about you do us a quick favor and let us know what brings you to the session today. We'd love to know if you've taken classes before with Roger or his team, basically what your familiarity is with Fiscal Advantage, and anything you want to share with us would be greatly appreciated. So please put your notes in there. And also just know that Dan is joining Roger too. We'll do the proper introductions here in just a moment. But the reason I mention it is that it does really allow us to answer questions throughout the presentation without you feeling as though you need to wait until the very end and trying to cram them all into the last few minutes. That's not our mission here. Our mission is to get your questions answered as quickly as we can while they're fresh on your mind. So please put us to the test on that. As far as CPE goes, it's really basic. Same is true for all the classes that we offer. We have polling questions. There are 6 of them, which is actually a couple more than required by NASBA, but we need to make sure you respond to them as quickly as you can. We gave you some extras here. First of all, it's just a really great way to make sure we're staying on point, to get to know you as well, and to keep the session really engaged and engaging and interactive. And so it'll be pretty obvious when those polls happen. We're going to replace the PowerPoint, or it's really a PDF that you're looking at, with the polls, and you'll have a little radio button there to respond to. We'll give you about a minute to do that, but please answer them as quickly as you can so we can close those down as quickly as we can and move on. Speaking of that PowerPoint, though, the PDF version is what's been made available to you in GoToWebinar, so you can find it in the GoToWebinar side panel. You can also log into your account and find it there. And if you have any issues at all, just shoot us a note, Nathan, or I can certainly provide you with the PDF. We do want to make sure you have access to everything, including a recording to the session. So we are going to record it. We're going to post it to our library. That will happen a little bit later on today. So Roger, I just want to welcome you yet again to our platform. We love having you. We're very much appreciative of the content that you offer, and we know our members are as well. So with that, it is my pleasure to turn the presentation over to you.
Great. Thank you very much, Scott, and welcome to everybody. We're going to basically go today and talk about how to use fiscal analytics to improve cash flow, profitability, and therefore business value. Our mission at our company called Fiscal Advantage is really to assist companies that want to implement change to increase their cash flow and profitability and therefore their business value. We team up with strategic business advisors who want to facilitate that change for the businesses that they serve. Our software platform provides a proven process to evaluate the key financial parameters that are crucial for optimizing business performance. My name is Roger Jacoby. I'm the CEO of Fiscal Advantage, the creators of the Fiscal Checkup software. Dan O'Connell is online today. He's actually the founder of our company, and he's online to answer questions. So we'll be moving rather rapidly through a whole bunch of slides, and if you have specific questions, rather than interrupting the flow of the presentation, Dan will be able to answer your questions very quickly by just typing them into the questions panel over on the GoToWebinar panel on the right-hand side. So every calculation you're going to see in the next hour can be done manually. It also can be in a spreadsheet. And in fact, we're going to give you, if you want, the industry data so that if you want to do all these calculations on their own, be our guest, you can do that. We're also going to be showing you how software can be doing the heavy lifting. We're going to go through a pretty deep analysis here in a moment. I promise this next hour will be educational. If you want to understand a process, and that's what we're really talking today, is a process of evaluating companies, I apologize because at times it may come across as a little promotional, and I apologize for that in advance, but if you instead focus on what we're doing in the process and what you can do with the data, I think you'll clearly see the value of implementing a process like this, whether or not you choose to use software tools to help your business clients improve their performance. So here, just looking quickly at the agenda, we're going to have a very brief introduction, and then we're going to look into what we call phase one of the process. And this includes an assessment of the company's historic performance. We're going to go into break-even points. We're going to look at key accounts on the income statement and the balance sheet. We're going to explain the relevance of industry comparables. And we're even going to evaluate something we call sales quality. We're going to spend the majority of the next hour in this assessment phase where we're really trying to get down deep and understand how a company got to where they are today. Briefly, we're going to just have a couple of slides that talk about phase two, where we see how the past performance of the company actually translates into the value of the business today. And finally, we're going to look at what we call phase three, where we use the past trends of the company to forecast into the future, as well as understanding, if we choose to make some changes, what they're going to mean in the future financial performance of the company. We're going to then have a really brief introduction to something called benchmarking. So once you've completed phase one in assessment, you've established the value, you've understood the impact of making changes, benchmarking is a process to help implement change. And we have, in fact, an entire other webinar on benchmarking. We'll have that one this Friday if that's of interest to you, to know how to come alongside business clients and help them implement change. Please note that we're going to move fairly quickly through this process. It's quite likely you're not going to grasp 100% of everything you see. The goal here is to expose you to this overall process and also to show you how analytical software can actually do a lot of the heavy lifting for you in order to so you can spend the time actually implementing change. At the end of the webinar, I'm going to tell you a little bit more about other educational resources on our website going into the processes that we're showing you today. So our first polling question here is so we have an idea of who is in the audience. We're going to launch this and tell us if you're in the accounting world, if you're here as an independent business, banking, financial services. You can see the choices here. And again, if you have questions on anything I say, there's a questions tab over there. Please enter your questions, and Dan is on the line to answer your questions. The way this works is we wait till we get to 90%, so if you can vote quickly, we'll get through these questions sooner, and we'll give the 5-second countdown and show you the results here. All right, we're at 90%, so I'm going to give the 5-second countdown of 5, 4, 3, 2, 1. We have about 60% today from the accounting world. That's great. When we did these during tax season, we never got above 30% because you guys were all preparing taxes for people. We got about 20% private business. Welcome. I think even though we'll be talking a lot about this process and for the advisory world, this process is obviously driven to help business performance. So this is absolutely something you want to hear. So let me hide this and let's get started here. So let's start with two incredibly simple basic examples of what are fiscal analytics. You see a single data point here, 3.2% profit margin. Well, is this good news or bad news? Well, it kind of depends a lot on your industry. Because if you're like a grocery store or a gas station and you're used to having margins in the 1% to 2% range, man, this would be really good news. But for many companies, this is acceptable, but for many others, it would be pretty poor performance. So how do we know? Well, one of the things we can do is add the trend line for the company for 3 years. And we can see that the news for this company is kind of mixed. The company's doing better than they did in 2013, but they're doing worse than they did last year. And when we add the line showing the profit margin for their industry, for the comparable companies in their industry, we can see that this company is operating kind of below their industry peers, and there's probably some room for improvement for this company. So let's just look at one other example here. Let's just look at operating expenses as a percentage of sales. Again, I think you know you can't look at a single data point. When we add the company trend line, now that shows us that expenses are decreasing as a percentage of sales, which is a really good trend for this company. And when we add in the industry data, we clearly see that this company has expenses under control because their percentage is going down over time, as well as their performance compared to their industry. Now, in addition to looking at the company and the industry trends, analytics should also monetize the difference. So in this example, we should be able to calculate the amount of profitability that's improved because the company's operating better than their industry peers, at least in the operating expense area. So when we look at it here, we've got a simple income statement from this same company that the last two graphs are from, and this is the one we're going to kind of spend some time looking at today. And I'd hope you agree that there's nothing dramatic about this income statement, although they're growing at a good rate in the last 2 years, as you can see on line 2. We don't have a lot of time to allow you to study this in depth, but I would hope you'd agree that identifying the areas that need improvement are pretty hard to do just looking at the income statement. And similarly, the balance sheet from the same company shows the company's cash position is improving, but again, the areas that need improvement just don't jump out at us. So every company has financial statements, just like I showed you. But what we've learned is that most companies find it nearly impossible to extract what we call actionable data from their financial statements. It just doesn't jump out at us. So as you've started to see, fiscal analytics can be a bridge that links financial statements and the actionable data that most people want or most companies want out of it. What are fiscal analytics? It's the use of data to understand the components that make up profitability, cash flow, and business value. It provides businesses with the data to make the best decisions to improve their performance. Fiscal analytics should provide a financial roadmap for those companies that want to implement change and they want to thrive. So the process is really quite simple and very straightforward. First, and we're going to do this today, we're going to look at the historical performance. We're going to compare the company to itself and its industry. And then we go in to identify the opportunities, and we want to monetize those opportunities. So if we're going to make improvements, we're making improvements in the areas that are going to have the greatest impact for the company. And then finally, once you've decided what to do, you want to implement change to improve financial performance. So we're going to start our phase 1 analysis by looking at the income statement. So here for this company is the graph for cost of goods sold. As you can see, the company in green is operating worse than their industry, and I hate to say it, they're trending in the wrong direction. Now, if the company could just achieve, if you look back to 2013 where they got 70%, if they could just achieve that, they would add almost $160,000 in profits. And if they could achieve the industry average of 63.6%, it would actually add over $500,000 to the profitability of this company. So operating expenses, on the other hand, as we saw earlier, are below the industry averages and are trending in the right direction. And we can calculate that based on this performance, there's really no need for this company to necessarily focus on reducing operating expenses. So analytics should also be able to clearly identify the areas where a company is doing well as those areas that are needed to focus on improvement. So we're going to use the data from just the operating expenses and the cost of goods sold to calculate the break-even point measured in revenue. So here we're using the break-even table that's included in one of our reports, our executive summary. We can also calculate the break-even point in terms of days. Note that it's improved slightly over time. Using the data from just these two accounts, we would like to introduce you to the concept of something we call the attainable break-even. This concept is presented so a company can begin to understand the cost or the value of what we would call margin erosion. We've already seen that the operating expenses are below the industry and are currently at their best level. There's no real improvement that's needed here. But as we remember when we looked at the cost of goods sold, well, what would the financials of this company look like if they could just attain that 70% level that they already attained in 2013? We're going to refer to this performance level as the attainable days to break even because it was attained by the company in the very recent past. So as you can see, if the company could have maintained its cost of goods sold at the same percentage of sales that they did in 2013 and achieved their best operating expense ratio each year, the break-even point for this company would have been reduced all the way down to 263 days. Now, again, this company is growing, so both cost of goods sold and operating expenses in real dollars would be increasing as the revenue is increasing, but the percentage of sales should be maintained or go down as the revenue is increasing. Here we show the difference between the actual and the attainable as a variance. And when we look at profits, the historical net profit before tax, as was listed on their financial statements, is listed on line 5. This value is different than what was shown in the income statement because we've removed the owner's excess compensation. We're trying to get to a little bit more of a pure analysis here. But when look what the profit would have been if the company had achieved its best margins in all 3 years. We call this difference between the actual and what we call the attainable profit, we call it the unclaimed profit. This is the excess cost that's built into the cost structure of the business. The unclaimed profit variance is a percentage of the attainable operating profit, which shows that the opportunity for this company is significant. Now, in addition to comparing the company to itself, which we did on cost of goods sold, we also did look at the industry, and we look at their own optimal performances. We've seen significant insight can also be gained when you look at the company compared to its industry. This is especially important for those companies that are managing their business well and those margin percentages are under control. The process of comparing a company to a standard is called benchmarking. Now, the most common comparable used by companies is called the industry average. There are some sources online. For example, you could compare your company to a specific public company in your industry. We use data from a company called RMA, which is comprised of over 260,000 mostly private companies, and the data is input by the banking industry, so we're really certain a lot of it is put in accurately. Now, there are some databases available, whether you go onto the library or something, you can actually look up in some databases. You can look up data by NAICS code, but one of the difficulties for many companies is defining a single code that represents their own company. So what we do here, and we're the only ones we know that do this, we actually let users or companies select up to 5 different codes along with the percentage of revenue that comes from each code. And then we use the software to create a custom hybrid industry comparable that is a mirror image of the company being analyzed. Time for our next polling question. If you think about those industry codes, how many industry codes, if you're a business, how many industry codes do you think it takes to describe your business? And if you're a business advisor and you think of the companies out there that you work with, on average, what do you think how many codes it takes to describe most of the businesses that you work with? And again, I'll remind you, if you have questions on anything I say in particular, please go ahead and reach out to Dan in the questions panel. You guys are doing good. We're almost at 90%. We'll actually maybe have some time for some questions at the end. So let me give the 5, 4, 3, 2, 1. I will close this. I will share the results. And this is very, very consistent. As Scott mentioned, we've been running this seminar since the beginning of this year. Generally, we have about 10% of the companies that feel they need more than 6 or more codes, but fully 90% of the businesses, with the majority needing between 2 and 5. That's very consistent. So I'm going to hide this, and I'm going to move right along. So continuing with our analysis, we've been looking at the income statement. So let's look at another example of how analytics can be used to make better business decisions. Let's look at the profitability for the change in sales for this same company from 2014 to 2015. So note here that sales went up by over $800,000 from 2014 to 2015, but the operating profit was actually an operating loss. But why was there a loss? Weren't the incremental sales of $800,000, were they profitable or weren't they? Well, we need to separate the loss into the portion that's due to the change in the ratios from the portion that's due to the increase in sales. So the gross profit percentage decreased, meaning the cost of goods sold increased faster than sales. This margin erosion in their cost of goods sold cost this company over $134,000 last year. On the other hand, as we saw in the operating expense graph, their operating expense as a percentage of sales went down by over 1.5 basis points, which actually contributed and improved profitability by just over $100,000. So looking at the total, the operating loss due just to the ratio changes of those two accounts was almost $33,000. So when we look at that $800,000 increase in sales, we can see that it actually contributed about $22,000 in profit. In fact, had we not had these profitable sales, the operating loss would have been about $33,000. When we look at the profitability of the new incremental sales, you can see that they're more profitable than the historic or base sales in 2015, which is much, much better than the prior year. This is a positive trend in spite of this company's operating loss on their 2015 results. Let's briefly look at growth rates. In the chart, the green line is the actual growth rate measuring the change in sales year over year on their income statement. But note that the sales growth looks pretty good here. But the mustard-colored line is what we call the real growth rate, and which is half of the assumed growth rate, and it's trending down. Well, to calculate the real growth rate, we remove changes in cost of goods sold and price increases, so a price increase alone cannot be misinterpreted as sales growth. Sales aren't growing as fast as some in this company might think. The red line, well, that shows the growth rate that can be sustained based on the assets of the company. So since there's other kinds of companies out there that don't have cost of goods sold, we must be able to look at other parameters on the income statement to evaluate performance. So here we have payroll to sales ratio. Now, this is a very positive trend for this company, showing good productivity improvements. This is a critical graph for service companies where payroll generally makes up the majority of the expenses. The overall 3-year trend for sales or revenue per employee is trending up, but it needs to be watched closely to make sure it doesn't start trending down. We had a little blip down in 2015. This also is a good measure of employee productivity. Like the previous graph, profit per employee overall 3-year is trending up, but again needs to be monitored to ensure that the trend recovers. If this trend does not pick back up, then the business should evaluate why the productivity has deteriorated. The last area to look at on the income statement are capital expenditures. Now, capital expenditures have been relatively flat over the past 3 years, which, when you consider the significant increases this company's had in sales, that might suggest that this additional investment might be needed in this area. So the potential for underfunding of capital expenditures actually becomes more apparent when we look at another graph or another ratio here, the net fixed assets to sales ratio. And we realize how this company compares to its industry in their asset turnover. Now, when we get to the forecasting part of this webinar, we're actually going to increase our funding for capital expenditures to try to reverse some of the trend that we've seen here. So let's look quickly at what we've learned so far from applying analytics to just the income statement. Cost of goods sold is a significant opportunity for improvement, so we're going to give that one a red flag. Operating expenses, on the other hand, were well below the industry averages, and they're trending down, so it gets a green check mark. Sales margin review, well, the current year sales were more profitable than the base sales. The real growth rate, while it wasn't positive, likely due to the same cost of goods sold issues we mentioned above, the payroll to sales is trending in the right direction. Sales per employee, trending in the right direction. Profit per employee, also trending in the right direction. And finally, capital expenditures could use some further investment. Who knew you could learn so much from just looking at an income statement? So let's move on to the balance sheet. AR days in 2015 were just over 35 days, which was well below the industry average of 47 days. And this great performance generated an additional $181,000 of additional cash flow compared to their industry. This is confirmed when you look at the receivables as a percentage of sales. This, for this company, is a very positive trend. On the other hand, inventory days, although they're improving, but they're considerably worse than the industry average of 83 days. And in fact, this poor performance negatively impacted cash flow by over $250,000. This is clearly an area that needs to be looked at and improved. The slight improvement over the last year can be seen when looking at inventory as a percentage of sales, but ideally, this would be trending down. Finally, we're going to look at AP days. They were 47.5 days in 2015, which was much higher than the industry average of 29 days. Now, the trend is going in the right direction. They're paying their bills faster each year, but they do take 50% longer than their industry peers to pay their bills. Now, because the company delayed paying its vendors, they essentially received loans from their vendors, which generated over $200,000 in positive cash flow. So the fact that the company is paying their bills faster each year is confirmed when you look at the payable turnover ratio. Now, the cash conversion cycle is an overall measurement of the 3 working capital accounts. Now, the formula is really simple. It's AR days plus inventory days minus payable days. The total cash conversion cycle for this company was 94 days last year, which was just below the industry average of 101. Now, in 2015, that was the first year that the company's total cash management was better than their industry. Again, a positive trend for this company. Now, it should be noted that the key driver of this performance is their extending of their AP days, which is a strategy that might not be sustainable, and I'm going to guess if the company had more cash, they might pay their bills even faster in the future. Remember this table that we looked at earlier from the income statement review where we were able to separate the profitability into the portion that was due to the ratio changes from those due to the increase in sales? Well, we can complete an identical analysis on the working capital accounts. Now, driven by improvements in receivables and inventory, the change in working capital in 2015, due solely to the ratio changes, was just over $93,000. Again, the very positive thing for this company. We can also calculate that $188,000 in working capital was needed in order to fund the $816,000 increase in sales. This is a pretty important number for growing companies that they need to know this. They can quickly determine if or how soon they're going to need to visit their lender to fund their growth. So let's quickly review what we've learned from applying analytics to the balance sheet. Accounts receivable, well, that's better than the industry and it's trending in the right direction, so it gets a green check mark. Inventory, on the other hand, is much higher than the industry average, so it gets a red flag. Accounts payable, well, it could get a red flag because they're not paying their bills per the industry average, but because their trend is positive for right now, I'm going to give it a green check mark for this year. But this might be an area for improvement next year if they have the cash to support it. And the overall capital management was better than the industry for the first time in the past 3 years. Now, that kind of completes the analysis that we wanted to do in phase one, an in-depth analysis of the financial statements of this company. And most people are shocked to see how all of this data can be extracted from their financial statements. Time for a quick break and our next polling question. So as you look at your company or the companies you serve, which one area do you think has the greatest need or for improvement in your business or the businesses you serve? All right, we're at 90%. I'll give the 5, 4, 3, 2, 1. I will close this. I will share the results. And forecasting and planning, which we're going to get to in phase 3, just slightly beat out cash management. And it's interesting, in all but one webinar that we've done, forecasting and planning has always been the area most people struggle with. And I think you're going to like what we're going to show you in phase 3. We're going to take this and make it a lot easier for you. So let me hide this and let's move on. So we've completed an in-depth assessment of the past 3 years of the company. It's time to summarize the performance with a business valuation. Now, we've identified areas where they were operating well above the industry, as well as areas where they need to improve. The business valuation is kind of like, if you think about it, it's the ultimate report card on the success of a business. Now, it also provides a basis to evaluate improvements in the future. So we should be able to see the impact on the future value of the company when we make changes in parts of the business. So in the next couple of slides, I'm going to give you a very, very, very high-level overview of our business valuation. I had one on Monday. There's actually a complete hour-long, in-depth webinar on this subject. I'm only going to summarize the business valuation in 3 slides. We're not going to spend a whole lot of time on that today. But I wanted you to know that the level of sophistication that we go through to get an accurate valuation. So in order to ensure that a business valuation represents the real value of a business, it's often necessary to make some adjustments to the financial statements. Adjustments like assets not being at their fair market value on the balance sheet, or an owner having expenses that a new owner would not have. This table from our business valuation report shows the adjustments to the financial statements that have been entered in for this company. Cash management also plays a role in business valuations. If there's an excess or a deficit of cash compared to other companies in their industry when the company is sold, it will impact the valuation. Line 10 actually shows that this company, when compared to their peers in their industry, had actually about $26,000 more working capital than their peers. This would be added to the purchase price, but what I wanted to stress here is analytics and industry comparisons are the key for calculating this value. The software calculates the fair market value of the company. We use 5 different methods, and then we calculate a weighted average. The first valuation method is the discounted cash flow model. The second is based on what's called the capitalization of earnings method. And for the third calculation, we actually estimate the value on 3 different market-based multiples: EBITDA, book value, and earnings. We then average these market-based methods for a blended selling comparables valuation. Then we weight each method and we calculate the fair market value of the company. The software then provides a range of a plus or minus 10%. And finally, to validate the value that we've calculated, we actually go through a process here where we calculate what's called the buyer's return on equity, shown in line 63, assuming a 30% cash down payment. So in this instance, the 28.7% return is within the expected range for most buyers. So in our opinion, the fair market value that we've calculated has been confirmed. On the other hand, if the buyer's equity was above 30%, the return on equity, we would suggest a fair market value closer to the top end of the range. On the other hand, if the buyer's return on equity was below 20%, it might suggest a fair market value closer to the bottom end of the range. Soon we're going to be calculating the future value of this same company, so the only number you really need to remember from this analysis is the fair market value of just under $2 million on line 53. As I mentioned earlier, there's an entire hour-long webinar through CPA Academy that goes in depth to this business valuation. So we've spent the majority of our time so far looking at the past financial performance of this company, which is phase 1 in the process. Then in phase 2, because of their past performance, the company is worth about $2 million today. So let's look at the future. Well, what does the future look like if we just continue as we've been doing in the past? And if we choose to implement changes, how will those changes impact the financial health of the company? And finally, how do we implement a benchmarking system to facilitate that change? So the first 7 lines in the forecasting module look at the income statement ending with EBITDA on line 7. This forecast is based on allowing the current trends of the company to continue. Note that EBITDA grows each year to almost $400,000 in 2018, and that's fueled by the positive sales growth, and so far this looks pretty good for this company. But because of the working capital requirements of sales in lines 18 through 14, we show how the balance sheet will be impacted by those growing sales. You may recall that we actually calculated the working capital requirements of sales earlier in the presentation. The cash after operations on line 14 shows that there is sufficient cash to fund the future operations of this company. But finally, we also need to include capital expenditures and their related costs in line 15 through 17. If this company continues with their current trends, there's virtually no cash surplus by 2018. The forecasting module continues with an analysis of what we call the bankability of the business. Looking at the assets of the company, the software actually calculates the borrowing capacity based on the assets in line 24. Lines 25 through 29 look at the ability of the company to obtain financing. As it turns out, this company would likely be turned down by their lender for a loan. Most lenders must have a minimum debt service coverage ratio of 1.25 after a new loan is in place. At 1.25, this means the company can pay all of its debts with 25% left over for a cushion. At 0.83 next year, this company is actually at risk. The final line of the forecast shows what the business value will be as the company is growing over the next couple of years. Remember that the business value at the end of 2015 was just under $2 million. Since we've identified 3 areas that this company needs to improve on, how would the forecast change if we make some improvements in these 3 areas? Now, the top recommendations to improve performance are covered on the first page of our executive summary, and they specifically recommend to reduce cost of goods sold. As you remember, it was much higher than the industry average, and it was trending in the wrong direction. The second recommendation in our report says that the inventory also, because it's above the industry average, needs to be reduced. And third, as we discussed, the investment in capital expenditures didn't look like it was keeping up with the sales growth. So let's change our forecast by reducing cost of goods sold to 67.6% of sales, which will improve profitability. We're going to reduce inventory days by just 10 days, which will improve cash flow. And we're going to increase capital expenditures by about 40%, which is going to decrease cash flow. Now, in a perfect world, we'd set our goal to reach the industry average, but for this company, that change is so significant that for the purposes of this webinar, we're going to set goals that, with effort, we think could be reached sometime in the next year. Just so you know, this is a screen capture from one of our screens in our input wizard. You guys talked about forecasting and budgeting being one of the areas. Well, this is where we change actually forward-looking projections. The screen where you make changes to forward-looking projections here is called projected. And it's easy to make changes, view their impact on the financials, make more changes, etc. So let's make some changes in our three target areas. Note that the historic default for the company trend line, if you will, is calculated for each of these 7 accounts, and it's listed in the box below the place to enter the new data. So on the income statement, we're going to decrease cost of goods sold to 67.6%. We're going to increase capital expenditures to 1.8% of sales. And on the balance sheet, we're going to reduce inventory days by just 10 days. Let's first look at the income statement. The projections based on the company's historic trends are in this top table. You've already seen these. And in the bottom table, it shows the EBITDA based on just our change to cost of goods sold. Note the significant difference in the EBITDA with the new assumptions in the bottom table. Seeing the data graphically often helps you to visualize the improvements. Note that EBITDA was almost doubled with the proposed changes in the cost of goods sold. Based on the reduction of inventory days, which will improve cash flow, even with the increase in capital expenditures, which is going to decrease cash flow. The cash surplus on line 17, as you can see, increased significantly. Who would have guessed that 10 days reduction in my inventory days was going to have that kind of impact? And here it is graphically. Sometimes it's hard to imagine how just reducing inventory days by 10 days, even with an increase in capital expenditures, would have had such an incredibly positive impact on the cash flow for this business. And as you remember, this company wouldn't even qualify for a loan based on their previous financial performance. Well, based on the changes to cost of goods sold, inventory, and capital expenditures, they now qualify for financing. Debt service coverage ratio is also often a loan covenant, so these higher numbers will allow them to keep their loans in place. Graphically, the improvements in the debt service coverage ratio is more than double. Finally, we calculate the value of the business. And based on our 3 changes, the value of the business is about 80% higher each year. Graphically, the change in value is dramatic. So let me ask you a question. If this was your company, or if you were an advisor to this company, I would hope the next question would be, how do we implement some of the changes? Well, the answer to that is called benchmarking. Benchmarking is a process. It's not just a one-time look and see how the numbers compare. Well, what is it? As we've kind of seen, it compares the company to standards. It measures the gap to monetize the improvements. It develops a plan to close the gap, and it repeats the process to focus on continuous improvements. What are the standards? Well, as we've seen, we compare the company to the industry. That's the most common, but sometimes comparing the company to their own best performance and what they've achieved can be important, especially if the company's already operating at a level better than their industry. We've already touched on a lot of this process. The benchmarking process has 6 steps. First, you gather data. Next, you determine the gaps between the company performance and either the industry or the company data. That's basically what we've spent the last 45 minutes doing. Then the next thing, once you've set your goals, is you then communicate with the people responsible for making the improvements to get their buy-in. You devise a plan and implement. You monitor the results. As the results come in, you recalibrate, refine, and come closer to achieving the goal. The recalibration process is critical. Once you measure your success, you set new goals, and this is actually an ongoing process that in reality never ends. Based on the new goals from the new recalibration, you begin to monitor the new results. Benchmarking is done to promote the efficient use of time and resources. Now, as I mentioned, through CPA Academy, we have a separate hour-long webinar dedicated just to benchmarking. If you're interested, in fact, there's one coming up on Friday. If you want to sign up for that, I'm sure somebody there will send you the link. So looking at your business, our time for our next polling question, looking at your business, what role does benchmarking play in your company? Or if you're an advisor, are you aware even if your clients even have a system to benchmark and improve their performance over time? All right, we're at 90%, so I'll give the 5-second countdown of 5, 4, 3, 2, 1. I will close, and we'll share the results here. Clearly, we've only got 12% that have a formal program with goals. And I hope for those of you that have goals but have not a well-defined process, or those that don't have any goals, are you advisors? You don't believe your clients have a system at all? Clearly, this is an opportunity for you to provide a lot of guidance to your business clients. So I'll hide this, and we'll move on here. In the last couple of minutes, I'm allowed to give you a little more of a sales pitch. Hopefully this has been educational up till now. And I'm going to give you a really brief introduction to Fiscal Advantage and our Fiscal Checkup software. If you work with small to medium-sized businesses, have you ever wondered what other services beyond the tax and compliance work that they need from you? Interesting, in a recent survey of small to medium-sized businesses, 55% said improving financial performance was their top priority. Almost half wanted external help to accomplish their goals. 44% said their current firm had low or no impact on their business performance. Interestingly, only 12% plan to seek a new accounting firm. So Fiscal Checkup is an online software tool that was developed with a couple of goals in mind. First of all, we want to assist companies that want to implement change and want to optimize their financial performance. But we don't do this alone. We often empower and work with business advisors. They have the valuable information and the relationships, and for those that want to help their clients succeed, we actually can be a great catalyst to make that happen. We provide a proven process for companies that want to thrive. So we've kind of covered it today, but let me review the 3-step process. In the first phase, where we've spent the majority of our time today, Fiscal Checkup conducts a deep assessment into over 50 different financial metrics, including all the ones listed here, and we identify the areas that have the greatest opportunity for profit and or cash flow improvement. And once the specific recommendations have been identified, the software monetizes the precise profit, cash flow, and business value that could be generated if the improvements were implemented. In the second phase, we have to set a line in the sand, if you will, so we use traditional valuation approaches and we calculate the fair market value of the business. This is critical. We have to be able to measure future improvements against today's value. As I said, we have a dedicated hour-long webinar on just the business valuation tool. In the third phase, we forecast the business's financial performance over the next 3 years, assuming their current trends continue. but we allow you to modify any of the 7 variables here so you can clearly see how minor changes affect the future earnings, cash flow, and even the value of the business. And again, we saw a brief introduction to this tool today. Our 3-phase process is designed to empower the business advisor to help their clients thrive. A complete fiscal checkup consists of 6 different reports. The most important probably is the executive summary because it contains the overall summary and includes the specific recommendations for improvement as well as the forecasted results are all in the executive summary. But in addition, there's a profit driver report which does the deep dive on the income statement, a cash driver report which does the deep dive on the balance sheet, a business valuation, a lender's report which shows the business how their lenders are going to view them, and a complete industry comparable report getting into 54 different financial ratios. So Fiscal Checkup is affordable. It's only $495 per company being analyzed, and we do have discounts and subscriptions models for advisory firms that will be doing more than 10 analyses. So if your firm wants to grow your advisory service revenue because you will know exactly where your business clients need your help, and if you want to improve your business client retention, or maybe even growing the number of your business clients, then we believe Fiscal Checkup is a solution that's made just for you. So you can check us out with absolutely no financial investment and a minimal time investment. You actually can create 2 free reports for any business. At no charge, you can create what we call a fiscal report card, which gives you letter grades for 9 different areas of a business plus an overall grade. It's real easy. It takes less than 5 minutes. It only requires data from 3 balance sheet accounts and 4 income statement accounts plus the relevant industry codes. The second free report is a custom blended industry comparable report, and it's created by our software. This is where you give us up to 5 codes, the percentage of revenue from each code, and this is where we give you industry numbers. So even if you want free industry numbers for your own analyses, this is where you can get them on our website for free. So let me just see today as we look at what you've learned today, looking to see what will be some of your takeaways from this webinar. I believe this one allows you to choose more than one. There's only 2 more slides, and one of them is a thank you slide with my email, which will be next. And then when we're done with this, there will actually be another question asking about what further information, if anything, you want from our company. And we do have a monthly newsletter, but we've learned in the past there's a lot of people that just came for the credit and really don't want us sending them emails every month, even though we're trying to be educational. So on our last polling question in a minute, you'll even have the chance to be asked saying, take me off the email list, don't even contact me again, and we will respect your wishes. So please give me your votes here, and we're about to wrap up. All right, we've hit 90%, so we'll give the 5, 4, 3, 2, 1. I will close this poll, share the results. Cool. Maybe we'll see. It looks like 28% of you may be on Friday. Or I'm sorry, the 32% on Friday for the benchmarking. The business valuation, I think the next one is somewhere like July 12th is the next business valuation one. We've got free reports, great, and some of you plan to even use our software to order a fiscal checkup on a client. That would be great. So let me hide this. Let me just go to this slide. Here's my email address. If we can be of any service to you, please let us know. And then I'm going to just quickly, as I said, there's another polling question here. If there's any further information you want from us, including being removed from my email list, we're happy to honor your request. But if you want us to contact you, the one option on there, printed copy, that's over 40 pages. Please, if you select that, make sure you look at that. That's not a cheap thing we're sending you. If you want it, we'll be happy to send it to you. But most of you would think could just look at a complete email copy. But there's people like me that like to sit in my chair and read and make notes in the margin, so I actually like printed copies, but that's your choice of how you would like us to follow up with you if you desire any follow-up at all. And with magic, someone from CPA Academy is about to chime back in.
Ta-da! Thanks so much, Roger, for another great presentation. Really appreciate your time and expertise today. And thank you, Dan, for responding to all the questions from our audience. A lot of stuff in there. Thank you, audience, for your participation today. Let's see here. The audience wants to know about their CPE. We'll get that processed by tomorrow. So if you want to go and check your account by tomorrow morning, should be sitting there waiting for you. Have any issues, please contact us. I wanted to let everybody know as well, we, along with these live webinars, CPA Academy is offering self-study. You can see those at cpaacademy.org. If you can't attend a webinar at a certain time, it may be available on demand. And that's it. That wraps it up. Everybody have a great day. Hope to see you on future webinars today and the rest of this week. Thanks so much.